Our second speaker is Andy Profit. His topic is Dividend Investing, a Personal Journey. He's been a long-term member of AAI. Before he retired, he was a member of the board of Silicon Valley chapter, but he leads the income special interest group for the AAI Portland chapter. Topics that will be covered today is how to invest for a steady income stream, common tools and techniques to build and manage a portfolio, and basic guidelines for managing risk. And Andy is a long-term student of investing and a retiree, and has been a member of AAII for over 30 years. He has been on an 18-year journey building a steady growing stream of dividend stocks. To help, he draws on his management experience in business and engineering to construct a plan. By sharing his personal endeavors, he hopes to educate our members on how to use dividends for retirement income. Andy spent 45 years in high-tech industry, first as a design engineer and later as a senior manager. His final position was as the executive director of a trade association. He holds an MBA and advanced degrees in electrical engineering. And so Andy, you have the forum, and I'm looking forward to your presentation.
Okay, thanks, Lynn. Thanks to everybody in the Silicon Valley chapter, and welcome. I guess I'm going to be talking a little bit about dividend investing. I'm not so much on the specifics of how to invest in specific stocks, because there's so much stuff out there that can give you good advice, and I'm sure Harry Domish's newsletter is a good choice. This picture here is a picture of me after I've done a day's worth of dividend investing. So just as a thing, I just put up this disclaimer as usual. I'm not an investment professional by any means, and so everything you hear from me, you should take as a grain of salt, and check with your investment professional and do your own due diligence by all means. Don't just listen to what I have to say and go out and do some really stupid things, basically. Okay, this is basically income goals and income vehicles. We took at a lot of investment guidelines. I'm going to be talking a little bit about some tools that you can use to manage your portfolio, because it's really important when you have a portfolio of dividend stocks to be able to adjust to the market vagaries. And so we'll be going over that with some simple tools. And then I'll talk just briefly about some tax characteristics for dividend stocks. I think Harry has mentioned a couple of them already, and so I'll just reinforce what he's been saying, basically. And then how do you mitigate the risk in today's markets? As you know, the markets are extremely volatile the last few months, and it will probably be more so as we move forward and with the interest rates hikes and so forth. So there's some things that you can do to help you manage your portfolio. And I'll talk a little bit about a technique that I've been using lately, and that is ERPs. And then, of course, I'll be talking a little bit about debt to EBITDA ratios, because I think those are some of the important things that you can look at quickly and determine whether a stock is vulnerable to something. And then I'll close off with some closing remarks. And I've included in the slide set that I sent to you folks a bunch of references. If you want, you can take a look at those at your leisure. Those are the ones that I commonly use, and ones that I think you might find valuable to help you in your journey into dividend stocks. So those are in the references, basically. So basically, I'm an income investor. And so I'm looking for a stream of income. This is how I pay my bills and how we take our trips and do things that we want to do. So this is not your average, capital gains kind of environment. We're talking about income and income streams. So I want it to grow at a rate that's faster than the rate of inflation. So dividend stocks are suited to that approach, basically. And so that's why I particularly like them. And I like to preserve the capital, of course. I'm trying to optimize my income after taxes. And over time, that has become important. And I'll explain that a little later. The goal when I originally started this whole thing, and this was done about, it's more than, I think it's about 18 years now. What I wanted to do was to get to a 10% yield on costs by 10 years. In other words, what I started out to do was to find dividend paying stocks or a portfolio of dividend paying stocks that I could see a yield or a cash flow from them of about 10% after about 10 years of time. So this is not your average buy and sell within 1 year's time. This is a long-term strategy. Oops. And so income investing is really made up of a bunch of different kinds of vehicles. Now, I'm going to only talk about dividend investing. Harry has done an excellent job of covering how to deal with preferreds, and he has a newsletter, I think, that is pretty good for looking at preferred stocks. There are other vehicles as well. There's master limited partnerships, there's REITs, there's options, covered calls and covered puts and so forth. There's income mutual funds and ETFs, bonds. The list just goes on and on. But I'm going to just count dividends because I think at this particular point, it's going to take a lot of time to cover all these other topics. And, dividends is probably a good place to start for most folks. And that's what I would recommend if you're going to start to do this approach. So in other words, this kind of a strategy is aimed at folks who are, approaching retirement or in retirement. And so they're looking for a cash flow, not necessarily those capital gains. So this is not investing in Google or in Amazon or Tesla. This is just about getting cash in your pocket. So, in other words, we're trading off performance for stability, and that's typically the way I operate. I look for companies that give me a nice solid dividend and pay me for years in, years out. For example, Johnson & Johnson pays me a 7.7% dividend on the original investment. In other words, I do fairly well on Johnson & Johnson. Procter & Gamble pays me a 10% dividend. Now that's on the original cost. That's not today's market, of course. Now, of course, I could have also gone to Amazon or Alphabet, but those folks don't pay dividends. And so for an income retiree like me, it's Johnson & Johnson and Procter & Gamble. So I'm a kind of guy who says, well, I don't like dividend cuts. So if a company starts to think about dividend cuts or even approaches them, I have a tendency to sell. Now, there are a few exceptions to that, but and I'll go over one or two here that maybe you might want to find interesting. So, when GE slashed their dividend in 2018 and the price fell 34%, I was out of there. I was out of the company immediately. And just to go back to refer back to what Harry was talking about in his session, and there were a few questions about free cash flow. Free cash flow will identify pretty quickly when a company is going to slash their dividend. So I'm looking for reliable stream of dividends. You know, obviously that's not a guarantee by any means, but you know, it certainly is a positive step in the right direction. It's certainly not as safe as preferred stocks or bonds by any means, but it can do very well in terms of the overall period of time. So capital gains are more risky in my little corner of the world because I'm interested in income. And so I tend to give that second priority. That's not to say that I don't like capital gains, but you know, I see that as a second priority for the approach that I'm taking. You know, as I note here, you know, dividends are not guaranteed. So, you know, you need to think about them in the long term. So I buy a dividend stock and hold it for as long as I possibly can. As long as they continue to pay me the dividend and the dividend increases at a certain rate, then I'm a happy camper. Now, obviously, you know, you can see here, General Electric was in 2018 was one that I would have cut immediately because the dividend went from 12 cents a share down to a penny, and the price of the stock even dropped even more so. So companies like General Motors, but vehicle companies, Ford, you know, they will have a tendency because they're great companies, but they have a tendency to cut their dividends when things get tough. And so you have to look at the cash flow and make sure that that dividend is covered, so to speak. Citigroup was another one in 2019. Okay, so here are some of the typical business profiles that I have a tendency to look at. And this is not my original idea. This comes from Warren Buffett. If you read his book, he has a very nice section, and I referenced it in the reference section of my presentation. If the ROIC, or the return on invested capital, is below 5%, you're going to find that that particular sector or that particular industry is fairly volatile in terms of its cash flow. And so, you know, those are typically the airline industry or automobiles. They are very, very driven by the overall economy. And so when the economy does well, they do great. When COVID strikes, you know, the airline industry takes it goes to its knees, so to speak. So be a little aware of those. If the ROIC gets up to the 10 or 20% rate, then I start to get interested. You know, and that typically is sectors like hotels and packaged foods, grocery stores, drugstores, and so forth. The ideal company is one that pays an ROIC of greater than 20%. And up until about, let's say, last year, that typically was software, soft drinks, you know, those are the Coca-Colas and Pepsis and the pharmaceutical companies, and some luxury products and medical instruments. So let me turn to the taxes side of this thing just for a second here, because most people tend to overlook this. And I've just pulled a table up, and this is a table that shows you the tax filing status for people with, so let's say you're married or have a significant partner and you are looking for dividends. Well, as it turns out that dividends in this particular, the one that I've noticed in red here, is that the maximum you're going to pay on a dividend is 20%, period. So if you're in a higher tax bracket, say you're in the 30% brackets or even higher, dividend stocks pay you your takeout, the government taxes that you're going to be experiencing are going to be 20%, and that's it. So dividends, in that sense, are a good place to invest if you're in the higher tax brackets. So just kind of keep that in mind when you're looking at these dividend stocks. Okay, so here are my guidelines that I've been using over the years. My current yield on cost is about 12%. Now that's after I use the money to run my life, so to speak, or Jeannie's in my life. So that's pretty high considering, but we've been at it for a long time. We've been at it for almost 13 years or 14 years, I think. So what I try to do, and this is kind of the goal I try to shoot for, is I try to get for somewhere a yield on cost, and I'll explain that a little later, somewhere between 9 to 10%. In other words, what I do is I buy a dividend stock that pays, let's say, a 2 or 3% dividend, and I look for a dividend yield to rise over time. And so my yield on cost at the end of, say, 10 years' time should be around 10%. And as I can note it here, it took nearly 14 years for me to get to that. So you have some portfolio criteria that I use. Typically, I look for stocks that are, say 2.5% to 3% yield. And I'd like to see them grow their dividend 6.5% to 7% yearly. Now, that was true when I first started to do this, and it was fairly easy to do. But frankly, in the last couple of years, that 6 or 7% growth in dividends has diminished quite a bit. And I think that's probably due to the overall economy and the structure of the bond markets as a result of that. And I'll explain that a little later. So I'm trying to what I'm trying to say here is that I look for a yield and a growth of somewhere between 9 to 10%, which is the sum of those two, basically. And let's see. In terms of allocation, I keep a fairly large portfolio. My portfolio has 20 to 30 stocks in it at any given time. So any given stock in the portfolio is about 2.5% to 3% of the entire portfolio. And the reason for that is to mitigate risk. If something is going to happen to a particular stock and they cut their dividend, it doesn't impact my income very much, basically. And I just simply sell the stock and move on and try to find something else that is worthwhile. Okay, so I diversify across all the as major industries and sectors. I try my best to do that. Not always really good at that, but like, for example, recently in the last 4 or 5 months, I've been concentrating mostly on the financial sectors and on the medical sectors because those look attractive right now. And that was not true years ago, simply because I think those sectors look to be undervalued, so to speak. And as I said earlier, 25 to 30 stocks are in the portfolio. I have a few MLPs and REITs and 1 or 2 preferreds, but those are diminishing in their importance for a number of reasons I'll explain a little later. Okay. This is pretty self-explanatory, this slide. I won't say a whole lot about it other than that the portfolio growth can be accelerated by reinvesting the dividends. So let's say if you're, excuse me, in your 50s and you don't need to draw on your dividend portfolio, reinvesting is a fantastic idea because you can reinvest and reinvest and your growth portfolio will grow quite dramatically. It's accelerated by the reinvestment. And I think that's common knowledge. I think most people know that, but it really does work very, very well. And then I try to optimize for income tax purposes. That's obviously means that you want to try to do this in a tax deferred account. And it's probably best to put all your MLPs and REITs, if you can, in a tax deferred account, because typically, let's say a REIT will pay a higher dividend than a dividend stock will, or a qualified dividend stock. And so putting them in a tax deferred account makes more sense. And then again, I'll reiterate what I said a little earlier with that tax slide that I was showing. You know, if you're in the 12% tax bracket, and then you're paying zero taxes on your dividends. And if you're in the 15% bracket, it's there's your numbers. And if you're in a 32% tax bracket, which is a fairly high bracket, or you're moving up into those high brackets, you're still paying only 20%. So dividend stocks are a good deal. There's no question about it, especially if they're qualified. If they're non-qualified, then they're going to be taxed at your ordinary income rate. And so if you're, say, down here in this 32% bracket, you're going to pay at the 32% rate. Okay. All right. Everybody always asks me about selling criteria. And it's no different than any other criteria that you'd have for a stock. If there's a cut or a freeze or a suspension of the dividend, it's out of my portfolio. That's as simple as that. So I try to avoid stocks that are grossly overvalued. Just for your information, in my eyes, the S&P 500 is grossly overvalued right now. The whole entire, if you looked at the S&P 500, it looks very, very overvalued. And so it's very hard right now to pick dividend paying stocks because most of them are overvalued in that sense. So I look at the fundamentals to see if there's any impact. We could go into valuation, but it'd take 2 hours to go through all the tools that I use. But basically, what Harry suggested was correct. If you look at the free cash flow, if the free cash flow is there and steady, you'll do just fine. I look for announcements like splits, or maybe they're going to sell off or spin off. I have AT&T and I also have IBM. So I've been watching those very closely, and I can go over those a little bit later if you'd like. So the current value exceeds about 6% of the portfolio. I generally sell. I used to have a large holding in Intel. And so over the years, I've been selling off portions of that to get it down below the 6% number that I'm showing here. Now, one thing that I look at that I think is probably underestimated by most dividend investors is you have to look at the senior management. If the senior management has been in position for, let's say, a year or less, their influence on the stock is very, very minimal. It takes a long time for a senior manager to be able to influence how well the company is going to do. And so if there's a change in the senior management, that's kind of a yellow warning light I see. And it's something that would mean that I would watch that stock closely, because it typically means that there's going to be major changes in the way they adopt or do their overall strategy. And so it warrants watching them very carefully. And of course, if the stock is overvalued, I sell. For example, I've been selling some of my utility stocks, which were grossly overvalued the last 3 or 4 months. And then they will probably drop in price if we assume that the Fed is going to continue to raise their rates as they have announced over the next year or so. So they will be bargains later on, but not right now. I don't use margin. I don't do any shorting. I don't use options, although there are a lot of guys in our SIG group that do. And I don't use futures at all. And I look at the portfolio at least 4 times a year. Now, I'm not your typical investor in the sense that I'm not looking at it every day. But I do look at it more often just because I like doing that. But you really don't have to, maybe once or twice a year, maybe 4 times a year at the most. So. And I subscribe to a bunch of newsletters. My apologies to Harry for not having listed his letter. I get the Morningstar newsletter. I do subscribe to the AAII Dividend newsletter, the utility newsletter. I do use the Kiplinger newsletter, and recently I signed up for the Intelligent Dividend Investor, and then Value Line. And most recently, I signed up for Simply Wall Street. I'll talk a little bit about some of these. The Morningstar newsletter, I really don't pay for because the county library here has it online for free. And I think if you check at your county library, you may find that Morningstar and Value Line are often online available. And so I don't subscribe to either one of those. So I do subscribe to the other ones on this list. Don't ask me about Simply Wall Street because I just signed up for it. They gave me a special deal. So I don't have a lot to interpret in terms of their value, its value. So the graphics on it are spectacular, but the jury is still out on how good a newsletter it is in terms of providing information. So that's kind of my list of guys that I subscribe. And what I do is I typically look at the suggested companies that they recommend, and then I do my own due diligence, I guess you'd say, and go from there. Okay, so I'm going to give a little shout out to Gilbert Ho for, your Silicon Valley Computerized Investing Group is an excellent group. And Gilbert Ho does a slide deck at that meeting on the economy. And so it's well worth listening to what he has to say. I use it. I use Gilbert's recommendations or his slide deck pretty regularly because it's a good summary of what's happening in the economy. I'd highly recommend that anybody in the Silicon Valley chapter sign up for his Silicon Valley chapter, the computerized group. The other site I go to fairly regularly is EconPie, and that's just how it looks on Google if you look for it. And it's a very, very quick way to look at the overall economy. And they give a median estimate of the leading economic indicators and the entire portfolio of economic indicators and where they're at on the overall cycle. And so it's a quick way to get a picture of what's going on in the economy. And then I just move on from there. And then I, of course, use the St. Louis Fed because I think that's an outstanding site. If you want to look in more detail about what's happening with some of the indicators that you may want to follow. Aswath Domaranian I think he's a professor at NYU, has a series of valuation tutorials that are outstanding. They're excellent. If you want to take the time and learn more about how to do valuation of dividend stocks, or for that matter, any kind of stock, I would suggest going to his class. He has a series of online classes that he offers, and they're very good. They're excellent. And then he has a blog, which is called Musing on the Markets. And I read that religiously because it's an excellent perspective on what's happening with how to value the markets. And he gives kind of a lecture about what you should do and what you should watch out for. It's really, really good. The other one I subscribe to is Fast Graphs. For those of you who don't know what that is, it's a fundamental analysis service that gives you all the stocks graphed in a graphical fashion. And I really like that a lot because I can quickly look at a stock and determine what its perspective is, what its situation is. And then if I really want to get serious about it, I'll do a deep dive into that particular stock. And the guy who runs it is a guy by the name of Chuck Carnival, and he has a set of YouTube slides or YouTube videos, which he calls the Value Academy. And it's a tutorial on how to read a balance sheet, an income statement, and a cash flow statement from an investor's point of view. So I would highly recommend going to that and learning more, because it's a really good approach to how you can understand what's happening with your particular investment, your in particular dividend stock. Okay, so just a few little other tools that I use. I use Quicken Premier, and basically I use it to track the portfolio. When you have 20 or 30 stocks in a portfolio, it can take a lot of time. And so I use the online version. And so what happens is every month or so, I'll make an inquiry, and it goes out to my account at Schwab and Fidelity, and brings in all the dividend increases and price changes and so forth, and posts them so that I can look at them. Some of the other guys in our income sig here use Investment Account Manager. It's just as good. It primarily concentrates just on investments, whereas Quicken Premier will cover your checking account and your savings accounts and any other accounts you choose to put in. So I like it. I think it's pretty good. The only thing I would say about Quicken Premier is some of the report formats are awkward. I think they're not quite as what I would like them to be. I'm told that the Investment Account Manager has a better report manager, but I'll stick with Premier since I'm used to it, and I'm comfortable with it, so to speak. I guess I'm getting that way in my old age. Then I use OneNote as my journal. In other words, what I do is when I buy a stock, I make a note of what the reasons were I bought the thing. I usually make some assumptions, like what my logic was, my line of reasoning, so to speak. And I can put that in the journal section in OneNote. And then I refer to it from time to time. If, for example, a Morningstar makes a worthy comment about let's say Johnson and Johnson. I will cut and paste that commentary and I'll put it into OneNote under Johnson and Johnson. So now I have a journal, which is kind of a chronological journal, which keeps track of all what my analyst community, my newsletter, so to speak, are saying about that particular stock. So I can refer back to it when I want to look at that particular stock. And so it's kind of a nice way if I can keep track of, what's going on. So it's basically a journal. And then, of course, as I mentioned earlier, I use fast graphs, which I think is a great tool. Now, I don't normally use the Schwab Market Edge. That's a service that's available for extra cost at Schwab. I don't use it. I don't pay for it, in other words. What I do is when I'm going to take a position in a stock, I usually use Market Edge because they have a very nice list of technical indicators. They have the MACD, they have the price to earnings ratios, they have the relative strength indicators. They have a whole bunch of technical indicators. And so I can quickly check to see, should I take a position in this particular stock or not? And I don't use the $15 version. I just use the one that they post on a regular basis, which is, I don't know, maybe once a month or so. And then last but not least, I use TurboTax. And of course, everybody I think uses TurboTax or some sort of a tax program. I do a little something extra with it. I take the TurboTax Premier, I download it onto my computer, and then I use it as a tax planning tool for the year going forward. For example, I've just downloaded the TurboTax for doing my 2021 taxes. I will create a separate file version of that, and then I will use that for tax planning going into 22. Now I don't, in other words, so I have a picture of that 2021 tax structure that I've had. And so when I move over to 2022, all those assumptions that I made in 2021 will be there in my 2022 version of it. And so I can start to look at what stocks I have to take my RMD, my required minimum distribution. Because if you are at my age, which is over the required minimum distribution age, I'm required to pull out of my IRA account a certain amount of money every year. And so from a tax planning point of view, I look at that RMD and I program that into my tax TurboTax. And then I look at my dividend portfolio and I say, well, gee, which one of these will I like to use to pay for that RMD? And so I generally look for the overvalued stocks that I would do that with. So it's kind of a tax planning tool, basically, is what I'm saying. I'm assuming that many people do this as well, but it's fairly common practice to do that. Okay, here's my quality scoring system. And I thank a guy by the name of David Van App. He's a common publisher on Seeking Alpha. And this table kind of summarizes how I rank the stocks that I have in my portfolio from a quality point of view. Now, over on the right-hand side is Simply Safe Dividends. That's a separate service that's available. Perhaps some of you subscribe to it. I don't use it, so I'm going to ignore that one, but I'll explain how this ranking system works. Let's suppose that I'm looking at a particular stock and I will go to the value line page that has that particular stock. If value line ranks the safety as 1, I give it 5 points, and that you can see over on the left-hand side, 5 points. If the value line financial strength is rated as A++, I will give it another 5 points. Then I go to the Morningstar economic moat page. And if it says, Morningstar says, well, this is a wide, I'll give it another 5 points. And then I go to the S&P credit rating sheet on the S&P 500. And if it's a AA or above, I give it another 5 points. So anyhow, when you go through all the stocks in the portfolio, what I can do is I can grade them based upon this point system. So this happens to be an old slide. I think I did this back in 2018. So these are not necessarily stocks that I own right now. But what I do is I have a little spreadsheet, and what I do is I give the point system here. For example, if you look here, here are the points that these stocks had at that particular time based upon their credit ratings with S&P 500. And here's the value line safety ranking. You can see, for example, McDonald's here had a BB plus, so it got a 3 points. Here's the value line ranking was a 1, and so forth for the financial strength. And then the economic moat number is 5, basically. So the total number, which is over on the right-hand side, is somewhere around, mine is blocked because I guess all the members are there. Let's see if I can minimize that. Oh yeah, there we go. So you can see, for example, on McDonald's, it's 18. So what I try to do is I try to find companies that are, I don't know, 18 or above, basically. And if they fall below that, it's kind of a flashing yellow light for me to go look at that particular stock and see if I need to do something about that, either sell it or put a stop loss in or something like that. And I do this kind of quality ranking maybe once or twice a year at the most. So basically, it's a very simple thing. I can do it fairly quickly within a short period of time, and it gives me a warm and fuzzy feeling. So when I sleep at night better, basically. Okay, so I'm going to go over some of the safety factor elements for another approach that I use. This is a fairly primitive approach. And what I'm trying to do here is look at stocks in the portfolio and say to myself, is this stock at risk in a down market? And so what I'm trying to do is find stocks that have a fairly low beta, and the stocks that I can purchase with a beta below 1. In other words, that they're less volatile than the S&P 500. And I will try to dollar cost average into those stocks if I can. So I use this little technique I'm going to describe here to do that, basically. And it's pretty primitive, but I have found over the years that it works pretty well. The bottom bullet is the one that you should pay most attention to. If the safety factor is between 2 and 4, then I consider that optimal, because that gives me protection against down markets. So let me explain what I'm talking about here. This is a table of stocks that I've owned. Some of them I still own. This table is a little dated now, so I think I did this back in 2018. Let me explain how it works. Let's take Duke Energy here, for example. There's Duke Energy. This is my cost basis price on it at the time I bought it. And as you can see, the market value on it right now is, when I did this chart, and it's not today, but anyways, it's at $70.78, whereas the cost basis was $76. So I'm in the hole for 7.39%. Okay. So if I divide the cost basis by the market value, I get a ratio. That's over here in this column here. So for Duke Energy, the value versus the cost is, let's see, where am I? I lost my 0.92. Okay, so 0.92 is, oops, let me get my cursor over here. 0.92 is the valuation appreciation ratio of that particular stock. Pretty simple. Cost divided by market value. Then what I do is I divide that by the volatility, and that is the beta. So for example, on Duke Energy, the volatility is very low. It's 0.11. So if you divide the appreciation ratio, as I call it, by the beta, you get a number which is over here on the right-hand side, and that is 8.37. So that number is greater than 2. It's even greater than 4. So in a down market, this stock will be fairly safe in terms of its price appreciation or price deduction or price fall. Remember, I'm not interested in so much at the price that I have to sell it. I'm interested in whether it's going to get to a point where I have to sell it. If the dividend keeps coming through, if they keep paying the dividend and increasing the dividend, even through a recession, then I'm okay. So what I'm saying is here, if you look at the right-hand column here, you can see that there are some stocks in this portfolio that are below 2.0. And those are the stocks that I would consider at risk in a down market. So let's take, for example, Microsoft. That's not true today, of course. This was done back in 2018, but it has a 1.61, I should say, safety factor. So this stock at that particular time would be on my watch list in terms of cash flow and whether more of the dividend would be at risk. So I can quickly go through my portfolio and look at all the stocks, do this calculation, and I do this maybe once or twice a year. And then I flag the ones that are below 2.0, and I say to myself, okay, those are the ones I need to watch carefully. All right, so since I'm an engineer by training, I plot them. I don't necessarily, you don't have to do that. I do that, happen to do that. And as you can see, the red line is the bottom axis is the beta, the 60-month beta, basically. On the left-hand side is the safety factor ratio. And as you can see, the red line is anything above the red line would be 2.0 or above. And above the 4 would be the green line. So you can see that most of the portfolio is over here in the area where I feel comfortable with the stocks. This group of stocks down here are ones that I would watch carefully to see what their cash flow would be in case of that they may cut their dividend. So this is kind of a quick way you can determine how your portfolio is going to operate basically over time. And particularly at this particular time, with the markets being volatile and the Fed starting to crank up rates, this could be something that would be a valuable tool to you. Okay. I'm going to talk a little bit about risk premium here because it's an important subject when you're doing valuations. Whenever I use a screener, the first thing I use is I look for the inverted version of the yield, or the, excuse me, not the yield, but the price to earnings ratio. The price to earnings ratio, if you invert it, if you do the inversion of it, it's basically the yield on your equity, basically. In other words, put it this way. If you have a stock that's trading at a 15 PE ratio and you invert it, that's a earnings yield of about 6.6%. So what I try to do is I try to find stocks that have an equity premium of higher than 6.6. Now, how do I do that? Well, there's a concept called equity risk premium. And basically what it does is it allows you to look at any particular equity and determine what its risk premium is. So the logic is this: if I buy a treasury bond, let's say a T-bill, that's risk-free. So I can buy that in today's market for around, I think it's around 2% now. Actually, I think it rose up very recently. So what kind of a risk premium do I need to have for a stock that I'm going to buy? And that risk premium, it would be what I would call the equity risk premium. And so how do I get to that? Well, there's a way that you can calculate this. It gets very complex. There's sites you can go to that you can do this with, but to save you a lot of time and effort, if you got a stock that has an equity risk premium of 6.6% or above, you're okay, because you're buying a stock basically that is commensurate with the risk that you're taking. If you're buying a stock that is below 6.6% return, then you're taking an unnecessary risk, because that's a risk premium that you should be rewarded for taking that particular stock. Now, there's places you can go to do it to get this information. I happen to use the equity risk premium site that's shown here, and this varies from time to time. You can, I don't know. There's people out there who will even give you the risk premium for utility stocks, or risk premiums for stocks that are found in India, for example. I don't do that. I think that's going way over the board. I just say, oh, all right, if it's 6.6% or above, then I'm interested in the stock. If it's below that, I'm not, basically. Now, that's not necessarily meaning that that's the only reason why I would buy the stock, but it would be a starting point for doing a more detailed analysis. So that's all I'm going to say about that. One last thing I think that's really important to talk about right now, because with the Fed rate, with interest rates being so low and companies borrowing so much money these days, looking at the ratio between the debt to the earnings before interest, taxes, and depreciation and allowances is a very important ratio, because a lot of companies have leveraged themselves to the hilt. And so I look at this particular ratio, and this is a fairly common ratio. It's used by credit rating agencies to rate companies, basically, and so to see whether they're worthy of lending money to, so to speak. So a high ratio is a risk factor, so to speak. And so I try to look for companies that have a fairly stable or low EBITDA, debt to EBITDA ratio, basically, and something below 5. If it gets above a 5, that's kind of a red flag for me. So here's a particular chart. This is you can pull this information up off of Yahoo or Morningstar, or I think even Value Line will give you this information as well. So here's a chart that I use. For example, the blue line here is the debt to the long-term debt for a particular company, and here is the earnings, the EBITDA earnings for the company. And what I'm trying to say here is that if you want to pay down your debt, let's suppose that you're a company and you want to pay down your debt, the only cash that you have that you can use to pay down that debt is the EBITDA, is the earnings before interest, taxes, and depreciation. So if the debt ratio rises against EBITDA, that's a problem. Let me show you an example of that. This happens to be AT&T. Now, it's no surprise to anybody who been looking at this particular company. This company has been in trouble for a while. And you can see that pretty dramatically here in 2020. The EBITDA ratio, the debt to EBITDA ratio was 6.8. Something had to happen with this company. In other words, they had to do something to unload that debt. And so what they did was basically they sold DirecTV and they sold Time Warner. And they probably should never have gotten in that business in the first place, but that's another story. So anytime a company has an EBITDA ratio above 5, that's kind of a warning sign that you need to look at, because that means that the company is at risk for not being able to sustain their debt load. And that will become a serious problem as we move forward, because what happens is, as the Fed raises their rates coming forward, and they're talking about 3 to 5 rate increases this year, these companies will start to feel the pressure. They will start to feel the load. And so there are caveats in those loan agreements that say that they won't be able to borrow much more. So these companies will be vulnerable to some issues. This happens to be one for IBM. I was looking at that the other day, and you can see that their ratio is very high too. Now, there is an exception to this. Let me show you that one. Bristol Myers Squibb. You can see here, for example, Bristol Myers Squibb, their EBITDA ratio was humming along for the last 20 years at a fairly low rate. And then all of a sudden, they went out and borrowed a huge amount of money. Well, as it turns out, Bristol Myers Squibb bought a bunch of companies. I think they bought Celgene or Celine or something like that. And so they are leveraging that to buy that. So I would expect their revenues to rise dramatically and their cash flows to rise directly as well. And so I would expect Bristol Myers Squibb to be an undervalued stock in that sense. But again, looking at this ratio would have given me a early morning indicator of what to watch out for. Okay, that's pretty much all I'm going to say. Just a few comments to close. This kind of approach takes a while to get going. So, you got to be prepared for an 8 to 10 year strategy to do this. Be realistic in terms of your income offerings. What else can I say? There is a point in your life as you get older where you're going to be approach a point where you're going to be cognitively impaired, as they say. And so you need to prepare for that. And so I would say that you should have some sort of an exit strategy for having an income cash flow or stream of cash flow that will be mitigated, if you're not more so, because there will be a point in your life where that will happen if you reach that point. So getting older means that medical expenses will rise. So you need to plan accordingly in terms of your overall portfolio and planning. Taxes won't disappear. Once you retire, they're there. There's a very nice article in the April 2018 article in the AAI journal that's well worth reading about this whole topic. Just to finish up, just put a plug in for the Portland chapter. We're based in Portland, Oregon. Todd Blickenstaff is our president. Does an excellent job of managing the chapter. The Income SIG meets on a regular basis. We meet monthly. You're welcome to join us. We talk about the kind of topics that you see here. So you're welcome to join us. Just send me an email and I'll put you on the mailing list. And here's a list of, this slide's a little dated. I should have updated it before our meeting, but didn't get around to it. Basically, we have all of our videos available there along with, and as well as the main chapter videos. So you're welcome to look at some of those videos. We try to get guest speakers. We've had Don Maurer speak to our group and Peter Lingane. So those guys are very active in the Silicon Valley computerized investing chapter. And there's others ones on this list as well. Okay. All right. Questions, mudslinging, or anything you want to ask me. I'll answer and I may not answer. Who knows?
So, hey, Andy, great presentation. I know you mentioned AAII National. So one question is, do you know if AAII has a model portfolio that is close to, how you might analyze stocks?
Yeah, they do. They have a portfolio that's available, I think, on their website. And then, of course, they have a newsletter that they sell, which I charge extra for, which is their dividend newsletter. I happen to subscribe to it. It's okay. It's not the greatest newsletter. It's not the worst newsletter. These guys try to do the best they can under difficult circumstances. So it's okay. It's fine. There's a bunch of stocks in that portfolio. Yeah, I've picked up some of their recommendations, and some of them I have not. Because I think they're not very good. But on the whole, I'd say I give them positive reviews.
Got it. And then in terms of your portfolio, how would you, I guess, describe your turnover? How often do you put, new, stocks in?
Out of the 30 stocks in the portfolio, I think I turn over maybe 2 or 3 a year at the most. Most of them are buy and hold. Most of them I hold it as long as I possibly can, assuming that they continue to increase their dividend year in, year out. And it has to be faster than the rate of inflation.
Got it. And you earlier listed a few subscriptions you use. What do you think about Investors Business Daily for looking at that?
I used to use it years ago. It's worthless for me. Investors Business Daily is more of a trader's kind of approach. It's a buy and sell kind of approach. They're more interested in capital gains, and they're a momentum based service. So, for a dividend investor, an income investor, just does not worth the money. I subscribed to it years and years ago, but frankly, don't use it. Sorry.
Do you have any, I guess, ETF or mutual fund recommendations that people should look at?
Yes, I do in the reference. Hold on, I can go to that. here's the ones that are most commonly mentioned. For example, in our little SIG group, there's quite a few guys who like closed-end funds too as well, who are doing that as well. I guess the one I use the most commonly is the Schwab one. I've used that like ETFs. ETFs in general bother me a little bit because you're looking at like, for example, the Schwab one I think is based on the S&P 500. Well, there's a lot of stuff in the S&P 500 that I wouldn't touch with a 10-foot pole, so to speak. So, and so that's the risk I see in ETFs. Now, there's an approach that is espoused by, I think the Silicon Valley Computerized Investing Group does a very good job of, is that you can buy and sell ETFs, on an ongoing basis and create a cash flow from that. And I would advise you to talk to Don Maurer or to some of the guys there if you want to use that approach. I don't use it too much. I think, if I were going to become cognitively impaired, maybe I would move into some of these ETFs. But I can do much better than some of these ETFs. So I tend to I don't use them myself, but I would not necessarily say that they're bad for anybody else. I'd say that, if you don't want to spend the time doing the research, spending the time, then ETFs are just fine. They're perfect. Yeah.
So, Andy, earlier you mentioned that your portfolio allocation is about 2.5% to 3% on each stock.
Yeah.
By cost basis. When you go to rebalance, what's the threshold you use for rebalancing?
6%. If it gets to be 6%, then I usually try to trim it down, back down to the 2 to 3% range. And so I do take capital gains hits when I do that. Yes.
Got it. And is there a way to maybe, kind of highlight or repeat how you calculate the safety factor again?
Sure. Let me go back. Can I get back to there? Safety factor. Yeah, there we go. Was there a question particular on here that for that person, if they want to unmute their mic and ask?
Well, so for example, up top, you say safety factor is the market value divided by cost divided by beta. Is that kind of the formula?
Yes, the formula is over here. The safety factor is price divided by cost divided by beta. That's shown over here in the right-hand column. Does that answer the question, I think?
I want to make sure that that answers your question. I think earlier someone had mentioned that. And then maybe along those lines, what's your current sentiment on AT&T, GE, and Verizon? Are those three something you've done a safety factor on recently?
No, I haven't. I haven't done that's on my little list of things to do next week. Let me talk a little bit general about utilities because they are really utilities in that sense. Their cash flow is fairly steady, right? So what happens, let's back up a second here. What happens when the Fed starts to increase rates? Well, when the Fed starts to increase rates, that means that the bond market values rise more so at the short-term level than at the long-term level. The long-term level is driven by market factors. So let's say bonds go to 2%, okay? Well, the dividend stocks that are in your portfolio that are utilities will be impacted by that for two reasons. One is they're highly leveraged. They borrow a lot of money. So their costs, their capital cost, their cost of capital rises. And secondly, there's what will happen in the short term is that there will be a rush of people buying the stock. Because as those rates increase, people get scared and they think, oh my God, the recession is coming. They buy utility stocks. So the stock price may rise. There's pressure for the stock price to rise. Okay. But at the same time, the company itself has cost factors that they must deal with. And those are the debt load. Their debt load will rise. And so they get squeezed because they've got a stream of money coming in that's fixed. It's very flat. It's not rising very much. And so their debt load is rising. So their cost pressure is on for them. So the price of the stock over a longer period of time will drop. And when it drops and they don't cut their dividend, that's an important thing. It's an opportunity in disguise, because then you can buy that stock at a much better yield. So the answer to the question is, at first, when over the next year or so, I would expect utility stocks to be impacted by people rushing into them. Not so much on IBM and not so much on AT&T. That's a totally different story. But in general, there'll be a rush to rise, and the prices will rise, but then they'll start to dip. And when they dip, that will be an opportunity in disguise to buy them at a much lower price. So keeping a certain amount of cash in position for those opportunities will benefit you in the long run. When a recession occurs to an income investor, that's dancing in the streets, because your cash is valuable. Your cash will buy a much, much higher yield. So going back to AT&T, I think AT&T is still, I think right at the current price, around $20, $21 a share is a bargain, even if they cut the dividend, Now, I know that goes against what I said earlier in terms of the slides, but for that particular stock, I think it's well worth it. Their financial structure will look much better. They will look closer to Verizon at that particular point in time. And Verizon has done very well. It's done very well through all these ups and downs. So I think AT&T will be okay. Now, in IBM's case, IBM sold their division that they, which was the big mainframe division that which was, I think, probably profit-wise was probably not as attractive. And they kept the, what do they call it? The cloud version of their business. And the cloud margins are much, much better. And so therefore, I think that IBM is undervalued too. I think that it's an opportunity in disguise. Did I forget to answer that question?
This is great. So we have another question. David W., if you wouldn't mind unmuting, maybe you could ask your question.
Yes, hi, this is David. I think earlier you mentioned that you look at your goal is for yield on cost to be around 10% and all. But how do you calculate the year on cost? I've looked up on many internet sites. I could do it for simple cases where you hold on to a stock, and but when you're constantly dripping or reinvesting those dividends, I assume that goes up. But then the price of the share goes up too. So I'm not sure how that all works out for the year on yield on cost.
Okay,
I do that a little bit.
Yeah, sure, I can. If you're doing a drip approach, basically you're buying, your cost basis rises as a result of that, doesn't it? On your particular stock,
Well, the cost basis is fixed. I mean, well, when you first initially buy it, you have a set capital investment, and
Yeah, but-
then it goes up.
Yeah, but your dollar cost averaging into that stock,
Correct.
okay? So the average cost basis of that stock, um, well,
It rises.
Yeah, yeah.
That's why it's tricky.
Your question is a good question. I wouldn't worry too much about your yield on cost in that particular case, assuming that you're picking a stock who has a long-term trend upward and has a good growth in the yield. In other words, because your approach is going to accelerate the yield on cost dramatically because you're reinvesting those dividends. Okay.
Yes.
So, but don't worry. So don't worry so much about the yield on cost in that particular case. I'm not sure I answered your question properly. You want a specific number, and the yield on cost is only in your case because you're reinvesting so much. Is your cost basis will rise as a function of the reinvesting of the dividends. I wouldn't worry so much about that. I really wouldn't. Yeah.
Thank you.
It's only the model I'm saying was based on, you plug down your money at the beginning and then you don't reinvest in it again going forward. But in your case, you will accelerate it. That's definitely much faster.
Excellent. I think I've addressed most of the questions in chat. If there's something I missed that you would like to, make sure is answered, please feel free to type it in again. Otherwise, maybe Lynn, if you would like to, if you have a few words.
I'd like to thank Andy for an excellent presentation. We've, I think, really covered the income spectrum, or at least for two areas very specifically, and in general, just the methodology that are used. So I thank everybody for attending today.